So the way we like to do this is we're going to, I'm going to talk for maybe the first 5-10 minutes just about a little background on factors. How do we think about factors? How do we define factors? And then Antonio's going to talk a little bit about all the factors that we see out there, and then Pat's going to talk a little more in detail about how you use these factor-based strategies, how we see people using them in portfolios. And of course, along the way, if folks have questions, I know you can type them in, and we can kind of handle them as we go as well. But either way, we'll also leave some time at the end for questions. So just to get started, what are we talking about when we talk about factors? Everybody in the industry is always trying to find an interesting analogy or metaphor for factors. You see here, we say factors are the DNA of an investment portfolio. Other folks have said factors are to investing like nutrients are to food. You know, really, you don't need a fancy analogy. If you think about what a factor is, I think the easiest way is if you own the whole market. So if you own the global equity market, let's say, for example, and if that's your starting point, you have no factor exposure, right? You own the whole broad market. You have no exposure to anything outside of the broad market. Once you deviate from that, once you say, on average, I'm going to own slightly smaller stocks, I'm going to own slightly higher quality, I'm going to own disproportionately more stocks that have had better recent momentum, et cetera, now you have factor exposure. Now you have something about your portfolio that's going to make it behave differently than the broad market. And that's the easiest way to think about it. And I think what's interesting is, and we talked about this in the poll results, the important thing about factors, and this really started for a lot of us as a risk measure, as a way to say, how do I measure the risk of my portfolio, and how do I think about what's going to drive my portfolio? For a lot of people, it's a return measure. A lot of folks have said, and Antonio obviously can talk about this quite a bit, if I tilt my portfolio towards certain things, small cap, cheaper stocks or value stocks, maybe I'll get a better return over time. But just to level set, really, a factor can be anything. It's a way of measuring how are you different from the broad market. So it's actually, I think, a little simpler than some folks try to make it out to be. So we go then to the next slide. The other way to think about factor exposure and factors broadly is it's just a different way, or it's not even really a new way per se. It's a different way to look at a portfolio and to think about it. The style box, which is all the way to the left, has been around since the 90s. Morningstar came up with that, and you're looking really at two factors. You're looking at size, and then you're looking at value versus growth, right? It's a fairly rudimentary way to look at the market. It doesn't quite capture as many factors, I think, as we would like, but you're capturing most of the investable universe, and it's a very intuitive way to break out investments. Location's another one. How much do you have in any geographical location? How much do you have in emerging markets, Canada and the US, developed international, et cetera, however you want to think about that. That gives you an indication of the risk and return profile of your portfolio. Sectors is traditionally the way you do that as well. You know, if you have a significant weight to financials recently, you clearly have some value exposure. If you have tech stocks, you'll have some momentum exposure. So when you think about factors as a new lens, it's really exists in these other pieces. It's just a more deliberate, in our opinion, it's a little more deliberate, more explicit way to measure risk and return expectations of your portfolio. But I just want to be clear in saying that's definitely not something that we would argue is brand new. I think the tools are relatively new, but the concept or the thinking about it, as you can see, has existed for some time. We just have a more precise way to measure it now. So in terms, before we get into it a little more, I want to cover a little bit, how do we think about using factor-based investing in portfolio construction? And the slide, the graphic that you're looking at is how we at Vanguard tend to approach portfolio construction. And it is a funnel, it's like a half a funnel. The way we think about it is, if we don't know anything about you, and if you're just sort of the average investor, we're going to decide on your high-level asset allocation, how much in stocks, how much in bonds, et cetera. And then we're going to begin at broad cap-weighted indexes. So we're going to say, you know what, if you don't have a particular objective, if you don't have a particular risk target, if you don't have anything too specific about your situation, we just happen to know you're a 60-40 investor, we're going to implement your portfolio across cap-weighted indices, right? So we're just going to use beta products, capture exposure to broad asset classes, and that'll be the end of it. If we have a reason to want something different, so if you say, I have an income need, or I want to take less volatility than the market on average, or I have, if with the income need, maybe I want higher dividends, Maybe we think small cap or value stocks are going to outperform over long periods of time. That's a static tilt, and that's kind of the next step in the funnel where we could say, we're starting with broad market cap weight indexing, and now we're going to add a strategic long-term tilt into our portfolio construction to achieve some objective. Again, maybe we introduce minimum volatility or low volatility stocks or high dividend stocks or momentum stocks, et cetera, if we're trying to meet a volatility target or an income target or a excess return target. From there, and I won't spend a lot of time on these next two, so we don't do too much of it. Then next is security selection, and that's just traditional active management, where we say we want to have this much in equities, and we'll hire an active manager to try to buy, pick better stocks on average than the market. For us, there's a big step from a fee point of view, and I know fees was the last thing on our list, but still, fees are relatively important, particularly when you look out over long periods of time. Broad cap weight indices are usually the least expensive way to invest. Using factor products or style index products, which we'll talk more in a little bit about, can give you a strategic tilt in your portfolio without spending too much money on the fee side. If you do want to get into traditional active management, you generally have to pay a little bit more for that. Now you have folks trying to pick better securities. And then finally, the last thing is timing, and that's timing either when to be in or out of particular asset classes, when to be in or out of particular parts of the equity market. We're not big believers in timing adding a lot of value, and it's a pretty quick reason why. The primary reason is a lot of folks think that a timing decision is one decision. So for example, someone might say, hey, it's 2019, small value's done poorly for 10 years. Surely now's the time to add small value to my portfolio. Fine, that's one decision, but you have to decide, what do I sell in order to fund that overweight small value? And then you go into small value, that's decision number 2. And then at some point you have to say, I'm going to take that overweight off. That's decision number 3, and then you got to put the money somewhere else, right? And so that's decision number 4. So could it be easy to make the decision to go into small value? Sure, but you have to decide when to get out, how to fund it, and then how to where to put the money when you exit that position. So the odds of doing it consistently, time after time, over long periods of time, generally not in your favor. Certainly people can do it, but it's certainly not something that we think you can count on like you can broad cap weighted indices or even static tilts to deliver the same type of exposure and the same type of results over time. And then the circle to the right just implies, with any of these, you can think about doing anything within a portfolio on an active and a passive basis, which we're having to talk more about that later. We definitely view factors as being an active strategy. Once you depart from market cap weighted index as your portfolio starting place, you're in essence making an active tilt or using active strategy in general, because you're going to put stocks in your portfolio based on some criteria other than their market cap weight. So then on the next slide, I want to talk a little bit about the history of factors and using factors to explain traditional active managers' performance. And I always say here, if I only had one slide to use here today, it would be this slide. No one's ever asked me to do 45 minutes with one slide, but if they do, I'm ready, because I've already decided this would be the one slide I would use. But what you're looking at is the evolution of, really, attribution of active manager return. And all the way to the left, and you can think of this as being 35, 40 years ago, if an active manager and mutual fund outperformed the market, we gave them 100% of the credit for that. And we just said, you know what, if you beat the market, that's pure manager skill, a little bit of noise, meaning there's some stuff in there we can't really explain, but we'll give you credit for it. So it's manager skill and noise, that's what caused you to outperform the market. You go forward to the capital asset pricing model, which tells you that any portfolio has a sensitivity to the market, and a lot of the return of that portfolio is going to be based on that sensitivity to the market. So now we know that a big chunk of the return is really driven by how much beta do you have to the broad equity market. The rest of the return, we give you credit for it. That falls under now what we're calling pure alpha and noise. You go forward to Fama French, now we have the market factor, we have size and value as factors, which can be easily recreated, or we can account for that in terms of your return stream. So now we know your return is made up of the market, size and value factors, and the rest we give you credit for, and then so on and so forth. So when you get to the last column, you can see the market factor is part of it. Now we can look at size, value, momentum, volatility, liquidity, dividend yield, et cetera. Explains a lot of the return. And then what you're seeing at the end is really what is the active manager really adding in terms of idiosyncratic stock risk or through pure stock selection. And the idea of this is not to say that active managers can't add value. The idea of this is to say that if you're buying an active manager because you want factor exposure, so if you're buying a large cap value manager or a small cap growth manager, which is relatively akin to momentum, what are you paying for? And I think the question is, or the point we would make is if what they're giving you is primarily, that return stream is primarily driven by market factor and style factors, and the idiosyncratic stock risk or the stock selection alpha is there, but maybe it's there inconsistently, or you're paying 60, 70, 80, 90 basis points to get access to that. There's a way now where you can say, you know what, I'll just get the market and I'll get the individual factors that make up a significant part of the return of this manager, and maybe I can do that at a reduced cost. So again, I think when people talk about how much interest there is in factor-based investing these days, a lot of it has to do with the idea that I can get access to what active managers are doing, and I can have control over the factors I have exposure to, and I can do all of that at a significantly reduced cost versus what I used to have to pay a traditional active manager. And then so going forward, we'll talk, and I'm going to transition here to Antonio to talk about this. The one thing I think we hear the most is the question would be, so in that last column on the right, we just say style factors, factor 1 through factor K. How many style factors are there, right? And you hear a lot written about there's a factor zoo, there's hundreds and hundreds of factors. So I'm going to hand it over to Antonio to talk a little bit about, how many factors are there and how do we think you navigate that landscape?